Okay, welcome to the Infinite Wealth Q&A and update live stream, where we're going to be talking about all things infinite banking and passive income. And today, some of the questions we're going to answer is how safe are insurance companies? What are the tax advantage of infinite banking? And what happens if my spouse and I die at the same time? So if you have a question, go ahead and submit it in the question box. Or if you're watching this as recording, you can email us or DM us on any of the social media platforms. Um, so the purpose of this is a way for us to kind of share any updates or news to our clients and to others, and allow people to ask questions really about infinite banking or ways to create passive income, and kind of what we do here at Infinite Wealth. So we combine the teachings of Rich Dad Poor Dad and and becoming your own banker or infinite banking. And our goal is to help our clients create enough passive income, which is more than our monthly expenses. And that's how we define true financial freedom. Um, our firm, Infinite Wealth Consultants, focuses on infinite banking for investors. My name's Anthony Faso, and I'm a recovering CPA. I'm one of the founders here of Infinite Wealth. My other founder, Cameron, uh, is on spring break today or this week. So, fortunately or unfortunately, he will not be here. And what some of you may be thinking is that I'm going to take a lot of this time picking on Cameron. And you know what? I had thought about that. I had thought about creating a little monologue of just making fun of his amazing hair, Paul Mitchell, uh, his favorite movies, The Notebook and Don't Mess with the Zohan. But you know what? I decided not to do that. And the reason being is because he's not here. And it's not because I'm all high and mighty and don't want to make fun of Cameron if he's not here. It's just the opposite. That's that's the fun part of when Cameron is here and making fun of him. When he's not here, I don't see that little smirk that he makes when I give him a zinger. So naturally, there's probably be some ways for me to make fun of Cameron, but there's anything that was purposely prepared. Again, if you have any questions, go ahead and submit them in the chat. Now, the first question we got here is, let me post it in here. I got to imagine some people have been thinking about this. Um, okay. Okay. After all the recent bank failures, how safe are the life insurance companies? Great, great question. Now, a couple things just to point out. Let's just point out one thing. In the last financial crisis in 2008, do you know how many banks failed? 499. You want to know how many mutual insurance companies failed? Zero. Okay. Here's the key thing: the companies we're using are all mutual companies, which means they're not traded on the stock exchange. They're not owned by stockholders or Wall Street. They're owned mutually by the policyholders. Okay. So their view and their philosophy is very different. It's not profit motivated. It's more motivated to make sure there's going to be enough death benefit for the owners when they need it most. Okay. Also, the companies that we use are all over 100 years old. So, which means, and they paid dividends during every one of those years. What that means is they were profitable during this pandemic. They were profitable during the Great Recession, profitable during the Great Depression, profitable during the last pandemic that we saw of 1917. So, in our theory, they know something, that they have the experience, and they have a solid track record. So that's why we believe that is the safest place to store our money. And a couple things here, what got Silicon Valley Bank in trouble was a run on the bank, meaning people came in there to withdraw their funds and they didn't have enough cash because that cash was was deployed either to investments or to loans. And a prime example of this is in one of my favorite movies, It's a Wonderful Life. If you remember when George Bailey was about to finally travel and go on his honeymoon, and he stops by the bank on his way to the train station, and everybody was in there trying to pull out their money. And he says, "Hey, we don't have your money because it's invested in somebody's roof or invested in somebody's house." Right. And so that's what a run on the bank is. But unfortunately, what amplifies it is called fractional reserve banking. I'm not going to get too into it right now, but in essence, what the government allows banks to do is for every dollar they have, they can loan out up to $9, which is great for the bank when times are good, but when times are not good, it 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 can be very bad. Now, what you might be thinking is, well, couldn't there be a run on the insurance companies? Insurance companies have a lot of have a lot of cash value. What if people came in there and all of a sudden there was a run on the insurance companies? Now, a couple things here. Um, for one, when people are storing money at a bank, that's typically for a short-term purpose, right? That's how they're paying their bills, their groceries. They have maybe some savings there. Uh, those are all short-term dollars. But typically, when people are putting money in cash value, that's typically long-term dollars. They're not relying on that money to buy groceries or to pay their bills. Okay. But also we have to think about when there is a bank run, people people are worried about their money. Is the money going to be there? They're worried about safety and security. Now, insurance companies, I would argue, is the safest place to store their money. Okay. For one, they're not using the fractional re- reserve banking. So they have assets that they could liquidate if they needed to, but more importantly, um, people who in those times they're going to be looking for safety and security, so they would be more apt to potentially maybe take their money out of a bank that could fail and to put it into a different product that has a much more secure and long lasting track record, which would be whole life. So I think when things get really bad, people will be putting looking for safe places to store their money, and they will be doing that inside their policy. Um, One thing I'd like to make a point about the Silicon Valley Bank. You know, it's interesting to see how they're blaming and what they're saying created this. And what started it was a run on the bank where people started taking the money out. Okay, but you know what they're blaming it? They're blaming it on that they had bought treasury bills, and which is typically considered a safe place to store their money. But what had happened is when they were buying them when interest rates were lower. And for a bond, the way a bond is valued, it's contingent on the current interest rate. Meaning, if you bought a bond that was paying 2% and now they're currently paying 5, you're going to pay less for the one that is 2%. You're going to pay the amount that's less to make that equivalent to paying 5. So when you're trading bonds, if you have a bond at a low rate, it's going to lose its value as rates go up. And so they had sold a big chunk of their bonds at a loss, which that loss created some issues with their balance sheet. And so they had to resolve that for to meet the regulation requirements. So they first tried to go out and to raise stock, and then when that didn't happen, that and coupled with the run on the bank, that's what would made them to close. But what nobody's talking about is why were they selling those bonds? I mean, it, they would know that they would be taking such a huge loss. So why why would they intentionally incur a loss that could risk failing the bank? And I think what nobody's talking about is the financial security or lack of security of that bank before. I'm going to share an article here. I can't do it now because I'm solo, but there was a article on a newsletter uh, sent out in February that's catered to the Silicon Valley, and they had talked about how this bank's debt to equity ratio was off the charts. And that's what created the concern. And then when people read that, they were concerned the bank would fail. So that's what I believe set everything in motion. It's not blaming the interest rates on the bond. It's because that bank was fragile. And then when word got out, then then the dominoes began to fail. So, but I will say there's going to be more coming out on that story, and there will be more that we will be sharing as well. Okay, so another question I got is we got this one yesterday. Um, what are the tax advantages of infinite banking? And what I see, what most people are looking at, they're looking at the tax advantages today, right? We have that short-term mindset. We're accustomed to, or maybe we're getting addicted to the drug of getting these tax deductions today. But one thing we have to remember, we're just delaying the tax. We get a tax deduction today. Let's say you put this in an IRA or 401k that's tax deductible. You get that deduction today. You get that tax savings today. But what about tomorrow? In theory, you're hoping that that $1 is going to turn to 3 or maybe $5. So now instead of paying tax on one, you're paying tax on five. I don't know. Do you think taxes are going up or down? I mean, if I think most people would say that they're going up. If they're going up, then why would we want to pay tax on five when we at a higher rate when we could just pay tax on one now at a potentially lower rate? But what we got to think about is the whole picture, not about the tax savings today, but what about the tax savings in the future as well? So ideally, I would rather pay tax on my dollars now when I know the tax rate, and ideally have that dollar never to be taxed again. So what the value of putting money, storing money inside your policy is that it's going to grow tax free, meaning that growth in there, which typically is about 4%, which 4% doesn't sound like a lot, particularly in this high interest rate environment. But as these rates rise up, dividends on the insurance companies will rise, and we should start seeing a higher rate of return inside the policies. But just remember that 4% is after tax. So depending on what tax bracket you're in, let's say you're in the 25% tax bracket, it's really the equivalent of earning six, paying the IRS, and that's where you get the four. But also, the goal isn't just to put the money in here. The goal is to leverage it and to buy assets. And by doing that through the policy, what we can do is the interest that we pay to the insurance company can be tax deductible as long as we are using the loans to create taxable income. Which mean I will tell you, uh, most of the time the tax code is a give and take, right? There's a, you know, let's just say for your IRA, you get a tax deduction when you put it in, but you pay taxes when you pull it out. So there's typically always, there's always a balancing act. The only place I've seen where it hasn't happened is when we leverage life insurance. What I mean by that is the interest you're paying is tax deductible, but the interest you're earning on that account is going to be tax free. So the advantages of IBC as far as tax goes is not focused today, but it's something that will be realized in the future. And I do strongly believe that the amount you're saving in the future will be much less than what you are looking at today. Now, another question we got. This was a good one by Moses. And this is something that we need to talk more about And what he said, it's a long one. I don't know if it'll pull up the entire thing. Okay. How can we add a beneficiary to both my accounts, which means policy, for him and his wife in case we die together or in an accident? Okay. Now I'd say that the best way to resolve this is that we should be having a living trust. Now, what a living trust does is typically we have a lot of our assets in the name or owned by the trust. And what that allows us to do is that when you die, your assets will go to probate, but the assets of the trust will not. So ideally, we want to move all of the money or all of the major assets into the trust, because what probate will do, not only is it very expensive and timely, but it's public. So other people are going to know what your assets are and could stake a claim to it. But once the money or the asset is in the living trust, it's not skipping a beat. So bank accounts can continue to be used. Nothing needs to be closed. And more importantly, we avoid probate. So what I ideally recommend is if we have this living trust, the living trust is the beneficiary. Uh, but then that way, if you have the trust, the beneficiary of all your assets, then if you want to make a change or a split and say, well, I want to give some to this child or that child or this person and that person, that might constantly change. And then that means you need to change every account you have. So every policy and the beneficiary of every account. But when that account is a living trust, it's already done. You can just make one change inside the living trust. And also that is going to be private. Um, that that's going to be private, so nobody's going to know what your assets are or who or who you felt that you wanted to give them to. uh, a little side note on living trust: if there's a policy you own on somebody else, for example, on your kids or on your business partner or somebody else, what I'd recommend is that the trust be the owner of that. And the reason being is if I pass and I have a policy on Cameron, if I pass, that policy is going, if it's in my name, is going to go through probate. So what I did is I put it on my trust as the owner. So no need to go through probate, and we were going to have still full access and control of that of that asset. Okay. Oh, so that would be the ideal, right? Now, living trusts are very vague. I mean, there's or maybe broad term, right? There's a lot of different types of trust and a lot of misconceptions. With a living trust, this isn't this we're not protecting. This isn't asset protected or creditor protected. This is simply avoiding probate. You need a different type of trust if you want to make something asset protected. But trusts are going to cost some money, probably around $2,000. And maybe that's a little bit too high in your budget now. That's okay. We have another alternative. And what that's called is a contingent beneficiary, meaning if your original beneficiary dies, like your wife, then automatically it goes to somebody else that you choose. So that is a form that can be completed with the insurance company at zero cost. Now let's see, we got another question here. I'm no longer insurable but would like another policy. How will me getting a policy on a family member differ from a policy I have on myself? Great question. Most of the time when we're designing these policies, it's not particularly for the death benefit, it's typically for the cash value. So, but the death benefit is a valuable aspect. So ideally, we'd like to make sure that you are insured, particularly if you have people relying on you. But if you're uninsurable, you can put it on anybody that you have an insurable interest. Now, for example, I have an insurable interest on Cameron because if he were to die, that's going to hinder the business. So I have an insurable interest on him. I have some key employees that if something were to happen to them, I'm going to be in a financial bind finding a replacement. I tell you, nobody's going to be as good as Becky. So I have a policy there on Becky. Now, as far as cash value goes, it's the same, whether it's on me, you, or a family member. The only thing that's going to be different is what triggers the death benefit. So if you have it on a family member, when they pass away, that's when the death benefit will be paid. Uh, if you have any other questions, I see Becky appreciated that. I mean, she is wicked awesome, is what we like to say. If you have any other questions, go ahead and put them in the chat, and we will address them. Let's see here. Now, here's another question here. I would say before I talk about that, we are doing. Oh, so here we go, right here. A couple weeks ago or a couple months ago, we had a podcast called Profit First for real estate investors. And Profit First is a great strategy. And what it does, as soon as a dollar comes into your account or into your business or personal life, you assign it a job, right? So you may have a job for taxes. So maybe a dollar comes in, you put a certain percentage in tax. Or for real estate investors, we may need to have a certain account for repairs, certain amount for management company, and a certain amount for our mortgage payment. And of course, a certain amount for profit. Because here's one thing entrepreneurs, investors forget. A lot of times we forget we need to pay ourselves first. And so we need to have that done at the beginning where we start setting aside money for profits. And the advantage of following this system is it's going to allow you to make better and quicker financial decisions. And what I mean by that, a lot of times, particularly in real estate, we really don't know kind of how we're doing. Maybe we can get a glance at what the balance of the bank account is, but we don't know overall, right? And in order to do that, we need our accounting done, which typically is not done till maybe a year later, which is going to hinder us from making good financial decisions. But with Profit First, you can easily take a look at your bank accounts and you're going to know exactly how you're doing. You're going to know exactly when it's time to maybe start managing or hiring a property manager, feeling confident about how much money you take out in profits and that you're not going to jeopardize the company. Okay. Here's a question. By Doug Reese, why would someone receive a 1099 interest from the insurance company on their policy? Where that would happen is technically not because of their policy. What you probably have is called a premium deposit fund. And that's one thing that we actually use quite a bit. And particularly right now with this run on banks, if people are sitting on a lot of money in cash, well, first of all, you're probably not listening to our content because you would have already moved it over into policy. But one thing you can do is just simply move that policy from a bank account into a policy. And we have certain designs, which we call a one and done, meaning you make one deposit and that's it. But getting a little technical, we can't make one single premium. Where we get because if we do, it's automatically going to tax, Douglas. So the way we get around it is in essence, we need to pay the premiums for 7 years for it not to mech. So in essence, what we do is we kind of like set aside those premiums for 7 years in what's called a premium deposit account. And or sometimes we call it a PDF. So while it's in there, that's where we're going to store the cash to pay the premiums for the future years. Now, while it's in there, the insurance company is going to pay you interest. And so that interest is going to be tax deductible, okay? Because it's not inside the policy, it's still technically outside. So, Douglas, that's probably why you are getting a 1099. If there's something different, reach out to us and let us know. We will gladly answer that question thoroughly for you. Let's see. Uh, Thought we had one more question. Now, this is a question we've been getting a lot. Douglas, thanks for your inquiry. If you got any more questions, please go ahead and throw them up now. Okay. So, with rising interest rates and bank failures, is my LELOC safe? Now, first, let me kind of explain what a LELOC is. And it's a life equity line of credit. And sometimes what we will do is to access the cash value of your policy, what the insurance company will do, they use your cash value as collateral and you borrow actually from the investment arm of the insurance company. With the LELOC, we work with banks that do things very similar. Okay. They use your cash value or your policy as collateral, and then we borrow from the bank. Now, typically the biggest advantage of that has been the convenience. I mean, you get checkbook access. Like, I just deployed some money for an investment last week and they needed a wire. I was able to do that same day. Also, you can put the LELOC on multiple policies. So somebody who has a lot of policies can be a little admin burden of keeping track of all of them. This LELOC just combines them all. And up until about a year ago, another advantage was the interest rates were even lower. Interest rates on LELOC were down to 3%. But those interest rates are variable. So right now, and they're typically tied to prime. So prime is 7.75 now. Okay. Now, depending on the balance you have, you may be able to have maybe a half a point or a point less than prime. But the problem we're having is here now, these interest rates on the LELOC, instead of being lower than the policy, they're actually higher. Now, full transparency, a lot of people don't realize that policy loans are also variable. The problem, they're variable and they're tied to the Moody's seasoned average bond yield. And what's the way a policy works, there's a minimum floor on the interest for a policy loan. And that minimum is 1 percentage point above the guarantees. So until 2021, before, guarantees in the policy were 4%. Thus, the minimum loan rate was 5. Now, in some of the newer policies, they're able to lower the guarantee, and a lot of companies we use lowered it to 3, which means the minimum interest rate is 4. Okay, but what's happening now is that Moody's bond index has actually gone up above the minimum. So right now, the companies are around between 5.5 and 5.7. So we're paying a premium of using the LELOC. So for some people, the convenience outweighs the additional interest. But for some people, it doesn't. And if it doesn't, we can easily unwind the LELOC and in essence, take a policy loan and pay off the LELOC. Now, a couple things on that. If we're having a PDF, and Douglas, that might be something of what I assume that you have. And we have a lot of clients that are doing that. And one of the advantages is we just move that money from somebody else's bank into that policy. And with this one-on-one design, very small loss of liquidity. In fact, even sometimes the year one is going to be higher than what you originally deposited. Okay, so the loss of liquidity is almost minimized. In fact, sometimes it's not there at all. However, when we have a one and done, we have our money in two spots, one inside the policy and one inside the premium deposit fund. We can borrow from the policy all day long, right? But the insurance company is not going to let you borrow against a PDF account, but banks will. So if you're using a PDF and you're going to need a LELOC to access that additional money. But I will say now with interest rates being high, we're kind of looking at some additional strategies. And also with the bank failures, one of the concerns is what happens if a bank we're using fails. Am I going to be able to access my line of credit, or am I going to be able to undo it and pay it off by the bank, by the insurance company? Those are some things. Those are valid questions. We want to make sure when we answer them, we have accurate answers. So I want you to know that we are aware of this concern, and we will be creating some content specifically addressing that. Um, what I will say is if you have some questions, is infinite banking for me, or does it work, or why isn't everybody doing this? Let's get on a discovery call. You chat with Cameron, or if you're lucky, you're get on my schedule, and we're talk about your questions, talk about your goals, and see if infinite banking's for you. It's not for everybody, and if it's not, we're going to tell you. But if it is, we will talk about the appropriate steps. Um, Now, as we are closing, any other questions, go ahead and pop them in. I would encourage you. We do have the Infinite Wealth podcast. We drop episodes every Tuesday, so we're on all of the platforms. Also, when we do when we do an interview on our podcast, we've been streaming it on YouTube. So if you subscribe to our channel, you're going to be able to get access not only to the raw footage before we cut out all of Cameron's mistakes, but also you can ask questions to however we are interviewing. And I will say, full disclosure, when Cameron and I are doing a podcast, we don't live stream it. And part of it is because we make so many mistakes. It gives us the ability to cut it out. And so we do this live Q&A every month, third Thursday at noon Pacific. You got questions and you can't make it, just email them to info@infinitewealthcourse.com or DM us on any of the social media platforms. And one final thing with I know we work with a lot of investors. So check out our webinar on Profit First. I will go ahead and put that in the link or in the notes here. And thanks for joining. Submit your questions. We are here to help. Go make it a fantastic day.